Welcome to StudyVix YouTube channel. Always study smart and master your future. Okay, let's get right into it. Today, we are undertaking a really crucial audio lecture. We're going to dive right into the heart of the Companies Act, 2013.
We are indeed.
We're talking about the whole compliance mechanism, specifically the requirements around preparing, presenting, and even revising and filing company accounts.
And this is fundamental stuff, sections 128 to 138. If you're a CA intermediate student, you absolutely have to know this inside and out.
Right. It's the bedrock.
It is. And what's interesting is how we're going to approach this. We're not just, listing out sections. We're looking at the statutory duty that's placed on companies and their directors.
A duty of integrity.
Exactly. It's all about financial accountability and transparency. We're going to synthesize these rules to understand how the law really enforces financial honesty.
So here's our mission for you, the learner. By the end of this audio lecture, you are going to master these concepts.
Mandatory concepts.
Yes. We're talking about the financial year, the rules for electronic records, which are becoming so important, and the very specific cases where accounts can be reopened.
And, of course, the big one, the role of the NFRA, the National Financial Reporting Authority.
And we'll wrap up with the board's report, what has to be in it, and the liability that comes with it. We're going to make this dense text, exam-ready knowledge for you.
Let's start at the beginning then, section 128, the foundation of it all.
The books of account.
Right. And the first thing to get straight, which sounds simple but has some tricky parts, is the legal definition of a financial year.
Okay, so the financial year, or FY, defined in section 241. The basic rule, the non-negotiable one, is that it has to end on the 31st day of March, every single year.
No exceptions for an existing company. March 31st is the line in the sand.
It provides that standardization, doesn't it? For tax, for reporting.
It does. But the law is smart about new companies. It adapts. This is where you need to pay close attention.
You mean for companies incorporated late in the year?
Precisely. If a company is incorporated on or after the 1st of January of any given year, its first financial year gets extended.
And it's a pretty significant extension. It goes all the way to March 31st of the following year.
Let's make that concrete. Say a new company, Mahindra Limited, is incorporated on February 22nd, 2023.
Okay. So after January 1st.
Correct. So its first FY doesn't just end a month later in March 2023. That wouldn't make any sense.
No, it would be a pointless set of accounts.
Exactly. So the law extends it. The first FY for Mahindra Limited would run all the way until March 31st, 2024.
So you get a proper, meaningful first reporting period, over 13 months in that case.
And the logic is sound. It prevents these tiny, truncated financial statements that don't really tell you anything about the business's initial operations. You need a solid baseline.
Okay, so that's the timeline. What about the method, the principles of bookkeeping?
Section 128 lays down two pillars, absolutely non-negotiable. First, every company must prepare its books on the accrual basis.
And second,
it has to follow the double entry system of accounting. You can't pick one. It has to be both.
And the accrual basis is so critical for accountability, isn't it? It's about recording transactions when they happen, not just when cash moves.
That's the essence of it. It prevents management from, playing games by delaying payments or rushing collections just to make the cash flow look better in the short term. It reflects economic reality.
So if we look at an example, say XYZ Limited wants to use the cash basis to keep things simple, the answer is a hard no.
An absolute definitive no. Section 128(1) gives zero leeway on this. It doesn't matter how big or small the company is. Accrual plus double entry. That's the rule.
Now let's get into something very modern. Electronic records, the reality for almost every company now.
Yes, and the law has caught up with technology. The rules here, specifically Rules 3.2 and 3.3, are all about digital integrity.
I like to think of them as the audit trail triad, 3 key safeguards.
A good way to put it. The first is that the accounting software must record a full audit trail for every single transaction.
So you can see its entire history.
Exactly. The second part of the triad deals with changes. The system has to create an edit log for every single change made to the books.
And not just what changed, but who changed it, and the precise date and time of the change.
That's the crucial detail. And the third, and I think the most powerful requirement, is that the audit trail feature cannot be disabled.
That's the checkmate, isn't it? It makes it impossible to go back and alter records without leaving a digital footprint.
It does. And beyond that triad, the rules also talk about retention and integrity. The electronic records have to be kept completely in a format that's unaltered.
That puts a huge responsibility on a company's IT infrastructure. Backups, security, everything.
It does. And it extends to branches, too. Information coming in from a branch office cannot be altered at the head office. It has to be preserved as it was originally received.
Okay, so we have these records. How long do we need to keep them?
The standard rule is for a minimum of 8 financial years immediately before the current year.
But there's a catch, isn't there, if there's an investigation?
There is. If the central government orders an investigation into a company, it can direct that the books be kept for a period longer than 8 years, for as long as the investigation needs them.
That makes sense. What about information stored overseas? Say a director needs financial data from a foreign subsidiary.
There's a formal process for that. The director has to make a detailed written request. They can't just ask for it informally.
And the company has to respond quickly.
Very quickly. They have to produce the information within 15 days of getting that written request. The law doesn't allow for stalling just because the data is in another country.
And finally, the penalties. What happens if you don't follow Section 128?
The fines are significant. The penalty starts at 50,000 rupees, but can go all the way up to 5 lakh rupees for the officers in default. It's a serious contravention.
Okay, so that's the foundation. Now let's talk about the output of all this bookkeeping. The financial statements themselves under Section 129.
Right. And the absolute core principle of Section 129 is the true and fair view imperative.
Which means 2 things, really. First, you have to comply with the notified accounting standards.
Whether that's AS or IND AS.
Right. And second, the statements as a whole must give a true and fair view of the company's state of affairs. So, compliance alone isn't enough. You need professional judgment.
Absolutely. But what happens if you're, say, a bank or an insurance company? They have their own specific laws to follow.
This is where the statutory exemptions come in. The law is smart enough not to create regulatory conflict.
So for companies in electricity, insurance, or banking, if their own special act requires a certain disclosure or prohibits one, that takes precedence.
And it's not considered a violation of the true and fair view under the Companies Act. It's a necessary reconciliation.
It is. Now, what about government companies? They also get some special treatment.
The big one is the exemption from segment reporting, right?
Yes. They are exempted from the accounting standard on segment reporting, which, for a massive, diverse public sector undertaking, is a huge relief.
But it's not a free pass. There's a condition.
Always a condition. This exemption only holds if the government company has a clean compliance record.
Meaning no defaults in filing its financial statements under Section 137 or its annual return under Section 92.
Exactly. Compliance is linked to the benefit. You default, you lose the privilege. It's a clever way to enforce discipline.
Now, let's think bigger picture for a moment. We're not just talking about listed companies. India has, what, over 11 lakh active unlisted companies?
A huge number. And many of them are very large and systemically important. Regulators are increasingly focused on their governance.
Which brings us to the 2020 Amendment Act. It seems to be looking ahead, doesn't it?
It is. It introduced a new power, an intention, really, to require certain large unlisted companies to prepare periodic financial results.
So not just annually, but maybe quarterly or half-yearly.
That's the idea, to get more frequent data on the health of these major private entities. Now, it's important for you listening to know that, as of now, no specific rule has actually been notified.
But the legislative intent is there. It signals the direction of travel. More scrutiny, more frequent reporting is coming.
Exactly. You need to be aware of it.
Okay, so what happens when things go wrong? When past accounts are found to be incorrect or even fraudulent, let's talk about Sections 130 and 131.
This is where we distinguish between reopening accounts by an external order, which is Section 130, and a company voluntarily revising its own accounts, which is Section 131.
Let's start with the more serious one, Section 130, reopening. This isn't something a company decides to do.
No, absolutely not. It's initiated by powerful external bodies. The application to the tribunal can come from the central government, income tax authorities, SEBI, or another statutory regulator.
And the grounds for such an order are very high. You can't just reopen accounts for a small mistake.
Not at all. The tribunal has to find one of two things. Either the accounts were prepared in a fraudulent manner, or the company's affairs were so mismanaged that it casts serious doubt on the reliability of the financial statements.
It's about a systemic failure.
It is. And there's a crucial time limit here, a sort of statute of limitations for financial reporting, the 8-year limit.
Right. No order can be made to reopen accounts for a period earlier than 8 financial years before the current financial year.
This creates a balance. It allows regulators to investigate recent history, but also gives companies some finality.
Let's use an example to make that clear. Chitan Ltd. is in FY 2023-24. The tax authorities want to reopen the accounts for FY 2012-13.
Okay, so the applicant, the IT authorities, is valid. But the year they want to reopen, 2012-13, is well outside the 8-year window.
So the application would be invalid on that basis alone. The timeline is a hard stop.
It is. And there's also a due process requirement. Before the tribunal issues an order, it has to give notice to all the relevant bodies, the government, SEBI, and so on, and consider what they have to say.
Right. Now, in contrast, let's talk about Section 131, the voluntary revision. This is the company trying to fix its own mistake.
Yes, it's a self-correction mechanism.
Yeah.
If the company realizes its financial statements or board's report didn't comply with the law, they could apply to the tribunal to revise them.
But there's a limit to how often they can do this.
A very important one. You can only do this not more than once in a financial year. It stops companies from constantly restating their financials.
And the process to get the tribunal's approval is pretty rigorous.
Extremely rigorous. The application needs a ton of detail. Contact info for the MD, CFO, directors, and even the former auditors who signed off on the original statements.
That's a key point, isn't it? The original auditor has to be involved.
They have to be. The tribunal will issue a notice and hear them out. They need to understand why the original statements were non-compliant. The company also has to advertise the application publicly.
It's a very transparent process.
It has to be. You're changing the public record. It can't be done behind closed doors. The NCLT's approval is a judicial stamp that makes the revision legitimate.
Okay, that brings us neatly to the big regulatory watchdog, the NFRA. The National Financial Reporting Authority under Section 132.
Yes, the apex regulator for financial reporting and auditing quality. Think of NFRA as the super cop for the biggest companies and their auditors.
So what are its powers when it comes to a company's accounts?
They're extensive. They can demand any information, any document, or any explanation from the company or its auditor.
They can also call people in for questioning, right?
You can. They can require the personal presence of officers and auditors. And here's the real power. NFRA publishes its findings of non-compliance on its website.
That's a huge deterrent. Public naming and shaming.
It's incredibly effective. But where NFRA's power is truly transformative is in its oversight of the auditors themselves.
You mean their power to review the actual audit work?
Precisely. NFRA can review the auditor's working papers, the audit plan, the risk assessments, everything. This is a game changer. It means they can see the auditor's thought process and professional judgment.
And they don't just look at one audit, they look at the whole firm.
Yes, they evaluate the auditor's overall quality control system. They can even require the firm to report on its own governance practices.
And if they find weaknesses,
they can direct the auditor to take specific measures to improve, changes to processes, changes to reports. They can mandate a full remediation plan. It's comprehensive oversight.
So how is NFRA structured to ensure it can wield this power effectively and independently?
The independence rules are very strict. The chairperson and full-time members must have no conflict of interest. They can't be associated with any audit firm during their term.
And there's a cooling-off period afterward.
A significant one. For 2 years after leaving office, they still can't join an audit firm. This is designed to prevent regulatory capture.
And its composition is a mix of different regulators, isn't it?
A very strategic mix. You have people from the MCA, the CAG, RBI, SEBI, and also from the profession itself, from the ICAI. It creates a holistic view of the financial ecosystem.
What about its legal authority? Does it function like a court?
It has the powers of a civil court under the Code of Civil Procedure. It can summon people, demand documents, and take evidence. And if you're unhappy with a punitive order from NFRA, you can appeal to the appellate tribunal. There's a clear judicial process.
Okay, let's shift from the regulator back to the company's own narrative. The board's report under Section 134. This is more than just numbers.
Much more. This is the director's formal communication to stakeholders. It's their story of the year, and the law dictates exactly what chapters have to be in that story.
For instance, it has to include the declaration from the independent directors, right?
Yes, confirming they meet all the independence criteria. It also has to lay out the company's policy on director appointments and remuneration.
One of the most important parts seems to be the disclosure of events that happen after the financial year ends, but before the report is signed.
That's a critical bridge. It ensures shareholders aren't blindsided by a major event, like a huge acquisition, that happened on, say, April 5th. It has to be in the report.
The report also needs strategic details, like on energy conservation and technology absorption.
It does, and foreign exchange earnings and outgo. Though it's worth noting that government companies in defense production get an exemption from this for national security reasons.
And a formal statement on risk management policy is also mandatory.
Yes. Now, for larger companies, listed ones, and public companies with paid-up capital of 25 crore or more, there's an even bigger requirement.
The board evaluation.
Exactly. They have to explain the manner in which they conducted the annual performance evaluation of the board, its committees, and individual directors. It's about accountability for the process itself.
And again, government companies often get an exemption from this as long as they're compliant with their filings.
That's the pattern. The report also has to disclose any issues with public deposits, any pending insolvency proceedings under the IPC.
And that very specific point about valuation differences in one-time settlements with banks.
Yes, that's a fascinating anti-fraud measure, forcing transparency on loan restructuring deals. The report also has to confirm compliance with the Sexual Harassment of Women at Workplace Act. It links social compliance directly to corporate reporting.
Which brings us to the absolute core of director accountability, the Director's Responsibility Statement, or DRS.
This is where the buck stops. Under Section 134.5, the directors have to personally sign off on several key things.
Like confirming that applicable accounting standards were followed?
Yes, and if there were any material departures, they have to be properly explained. And crucially, they must state that the accounting policies and estimates used were reasonable and prudent, all to give that true and fair view.
It's their personal stamp of approval on the integrity of the whole report.
It is, which is why the signing authority is so specific. It's either the chairperson, if authorized, or at least two directors, one of whom has to be the MD.
And if you get it wrong, the penalties are significant.
3 lakh rupees for the company and a personal penalty of 50,000 rupees for every officer in default. The law takes this report very seriously.
Okay, the documents are all prepared and signed. What's the final step? Getting them to the shareholders and the regulator. Circulation and filing?
Section 136 covers circulation. The documents have to be sent to every member and debenture trustee at least 21 days before the AGM.
That's the standard. But what if you need to hold the AGM on short notice?
You can, but the hurdle to waive that 21-day period is incredibly high. You need agreement from members holding a majority in number A and D, at least 95% of the voting power.
95%. That's almost unanimous. It really protects minority shareholders from being rushed.
It does. It shows that the 21-day period is a fundamental right. Although for Section 8 nonprofit companies, that period is shortened to 14 days.
For listed companies, there's also the website requirement.
Yes, they have to put all the financial statements, including the separate audited accounts of every subsidiary, on their website for public access.
What about a foreign subsidiary? Say an Indian company has a subsidiary in Italy, and the Italian accounts are in Italian and maybe unaudited.
Good question. The law says the foreign subsidiary's accounts should align with the Indian Companies Act as far as possible. If it's not possible, the Indian parent must file a statement explaining the reasons for the deviation.
So transparency is still the goal. Now, filing with the Registrar of Companies under Section 137, the 30-day rule.
That's the key deadline. You have 30 days for the date of the AGM to file everything with the ROC.
What if the accounts aren't adopted at the AGM?
You still have to file them within 30 days as provisional accounts. Then, when they're finally adopted at an adjourned AGM, you file the adopted copies within 30 days of that new date.
And if there's no AGM at all?
You can't hide. You have to file the documents anyway, along with a statement explaining why the AGM wasn't held.
And there are specific e-forms for all this.
Yes, like AOC4 NBFC for certain financial companies and Form CSR2 for corporate social responsibility. And for larger companies, there's the XBRL mandate filing in a machine-readable format.
The penalties for missing this filing deadline are steep.
They are. A penalty for the company starting at 10,000 rupees plus a daily fine, and a separate penalty for the directors and CFO, also with a daily fine. The message is clear. File on time.
Let's quickly wrap up with our final section for this audio lecture, Section 138, on internal audit.
This brings the audit function inside the company on a continuous basis. It's not just about the year-end statutory audit.
And it's mandatory for all listed companies and other large public companies.
That's right. And a common question is, who can be the internal auditor?
Does it have to be a CA?
It can be a CA or a cost accountant, but it could also be any other professional the board decides is suitable. And they can be an employee or an external firm.
So a company could switch from an external firm to an in-house internal audit department.
Absolutely. As long as the in-house system is robust and appropriate for the company's size and complexity, the choice is with the board.
And who decides what the internal audit actually looks at?
The audit committee, or the board, they work with the internal auditor to set the scope, the frequency, and the methodology. It's a customized function designed to manage that specific company's risks.
Okay, that was a huge amount of ground to cover. Let's try and summarize the key takeaways.
It really was. We've gone from the very basics of defining a financial year and the non-negotiable accounting principles.
Right through to the powers of the NFRA, the detailed contents of the board's report, and the strict deadlines for filing.
And I think the central theme that runs through all of it is accountability, enforced, transparent accountability.
With significant penalties to back it up.
Exactly. But here's what I find most fascinating looking forward. It's the emphasis on digital integrity that's now baked into the law.
You mean the non-disable audit trail in Section 128?
Yes. That single rule is a regulatory checkmate. It's using technology to enforce an unalterable history of every transaction. This is the future of compliance in forensic accounting.
That's a great point. And it leads to a final thought for you, our listener, the future CA.
Go on.
Given this huge regulatory push toward electronic record integrity, and knowing that the 2020 Amendment Act has signaled an intent to require periodic financial reporting from large unlisted companies, what technological compliance system would you recommend to a newly incorporated large unlisted company right now?
That's a great challenge.
You need a system that doesn't just meet today's rules, but one that is ready for the future demand of, say, unaudited quarterly reporting. How do you future-proof their compliance architecture from day one? Think about that. Thank you for joining this crucial audio lecture. Study smart and master your future.
Don't forget to like and subscribe.